Hi, my name is George Dagnino. I'm the publisher of the Peter Dac Portfolio since 1977. What I would like to talk to you about today is about the idea that bonds are a great investments, but not for interest, for what they pay. They're a great investment for capital appreciation if you buy them at a certain point in times in the business cycle. I will discuss this idea in other videos as well. But let me tell you why now is bonds can provide you with great capital appreciation when interest rates decline. Okay, I would like to show you now, and again, this is an approximation, but just to give you an idea of how the price of bond can change and how bonds are a great investment because of their capital appreciation. So let's make this example. Again, this is very approximate. The current market interest rates are 3%, and the corporation wants to raise money, so issues a bond for $1,000. And since interest rates are 3%, has to pay annually a $30 coupon so that the yield on that bond is 3%. If they were paying a lower coupon, the yield would be lower, and therefore they would not attract investors, obviously. So they have to have a $30 coupon. And it will not change for the life of the bond. Let's assume now that market interest rates decline to 2%. There are many reasons. That could be, for instance, the economy is slowing down, commodities are declining, inflation is declining. So interest rates decline from 3% to 2%. What is the value now of the bond? How much does it have to appreciate? Well, the new price of the bond, again, this is an approximation, is to rise about to $1,500 with a $30 coupon, which we said is not going to change. So how do I get the $1,500? Well, because the $30 coupon divided by 1,500 has to provide the 2% that the market demands. So really the bond, when all is said and done, the bond in this simple example appreciated 50% to reflect the change in market interest rates. So you see how bonds could become a great investment when in the part of the business cycle when the economy is slowing down, commodities decline, and inflation also heads lower. This is just a quick reminder that I published 3 books. This was commissioned by McGraw-Hill Education. In other words, they hired me to write this book, which was an MBA program that I taught for many years, but in a very detailed analysis of business cycles and how they drive everything from interest rates, short-term, long-term, commodity, stock prices, high yield, everything. And then I wrote 2 more books because these books explain how to apply these concepts, but to more specific, very simple investment portfolios that, by the way, outperform the market. So you might be interested in these 2 books that are practical. This is more strategic kind of a book. Well, I appreciated reviewing this video and these ideas, and I would like to remind you again, I published the Peter Dac Portfolio, and the subscription is available at www.peterdac.com. You can follow me on Twitter, on YouTube, on Tumblr, and I have a blog called Peter Dac and Friends. Okay, so long, and talk to you soon.